Welcome to the Nichols Tax Update podcast. Here's our standard disclaimer. I don't read it every week anymore, but I do want to acknowledge the value of my subscription to Tax Notes Today, published by tax analysts, in my opinion, the preeminent source of information for tax professionals, and I could not do this program without that subscription to Tax Notes Today. Well, let's see what we have to work with. 7 subjects in this edition. First of all, funds that are withheld from a pension are constructively received by the pensioner. Next, a utility company gets a private letter ruling that it may deduct joint development payments for a capital asset because that asset is part of an energy efficiency facility. And then 11 new questions and answers on COBRA subsidies and credits. An MBA education expense turns out to be deductible when education refines skills in established trade or business. We knew that, but what I don't think we quite understood is that the tax court might be more lenient on that issue than the Internal Revenue Service. And then we're going to have a little extended conversation about tax insurance and risks in tax return positions. An item on a tax home. Where's your tax home? It's where your job is. It's always been that way. And by the way, this decision's in the 11th Circuit, and the precedent on this decision was in the 5th. How is that possible? Well, the 11th was carved out of the 5th 3 decades ago. Next, updated frequently asked questions on paid leave credits for COVID-19 vaccines, 123 questions and answers in 15 categories, focused really on small employers, 500 or fewer employees, or fewer than 500 employees, that you can get a credit for what you pay the employees for time off to go get vaccinated for COVID-19. A retiree must pay taxes on his income, even though part of it was garnished to pay a debt. Michael Kissel, a tax court bench opinion. We're seeing more of those. The judge isn't even writing his opinion. He's delivering it orally from the bench. Amounts withheld from an individual's retirement distributions to pay an outstanding debt to his former employer, in this case the state of Pennsylvania, and to pay for health insurance were unreported income, even though he did not get the cash. The doctrine of constructive receipt applies, and the cash went to pay an obligation of his, therefore it's income to him. Next, a letter ruling, payment by a corporation to an entity with which it entered into a joint development agreement regarding an energy facility is deductible as an ordinary and necessary business expense under Section 162A in the year of payment, even though it created what would otherwise be classified as a capital asset. If by some chance there is an intervening regulatory agency that says you have to capitalize this, the IRS gives the energy company a second ruling in the alternative. If you do have to capitalize it, it's amortizable under Section 167. COBRA subsidies. No, not that kind. That's a real COBRA over there. No. Notice 2021-46. COBRA is an insurance program mandated by the Consolidated Omnibus Budget Reconciliation Act of 1985, and by the way, updated periodically every year or every other year since then, that gives most employees the right to continue health insurance coverage for a period of time after leaving employment. It's quite a social benefit that an employee can continue by paying the premium into the employer's fund. The employer's program can continue the same health insurance that the employer provided for the employee and the employee's family. That's the kind of COBRA that we're talking about, not that red-eyed green monster over there. Education expenses can be deductible. Ishizo gets a tax court bench opinion that he's entitled to fully deduct his education expenses for getting an MBA because he was pursuing that to refine his skills as an entrepreneur. He was actively promoting two businesses while he was in school, and he had been employed between his graduate degree and his MBA. He had been employed by a couple of consulting companies where he worked as an entrepreneur, promoting entrepreneurial businesses. So this is the business he was in. He can deduct the cost of his MBA. Then Julian Lardet-Morin has a slightly different take here. Again, the tax court is allowing the deduction. The IRS initially disallowed the deduction. And the court said, you know, we can understand why you did that, because it would appear that he's paying education expenses and those are not deductible, but you gave up the issue when the taxpayer presented you with some additional information. It doesn't mean that you tried the issue and lost. It means that you were convinced before litigation. Therefore, there's no significant dispute. You're not entitled to an award of litigation costs. But for us, the lesson is, I think, that if you can make a good case that your education expenses incurred to further the skills that you need in the business that you're in, you can deduct the expenses of getting an MBA. Tax insurance. Really? A wonderful article by Matthew Movafegi and Jordan Tamchin. Tax insurance may be the preferred solution to mitigate contingent risk for some tax positions. Evaluating risk in the application of tax law from apparently simple to obviously complex transactions requires highly specialized knowledge and skill. Not everyone has that. The issue has been a burning issue with tax practitioners for at least 30 years in my personal experience. The AICPA offers standards that attempt to classify return positions according to risk. I'm going to talk about that a little bit. The IRS relies on a code section and supporting regulation to decide on application of penalties when the tax treatment might vary from reasonable basis to substantial authority to more likely than not. Those are terms with which we need to be more familiar. So let's do that now. About those standards, Code Section 6662 imposes a penalty for a liability due to negligence. That's my parenthetical. Negligence in this case simply means a wrong return position. Code Section 6664 and its regulation number 4 explain a reasonable cause and good faith exception to the Section 6662 penalties. And disclosure on a Form 8275 may satisfy that exception by making a disclosure. Now, over on the right-hand side of this slide, I have a table, tax opinion standards. What are we talking about when we say that a return position will prevail? I'm telling you that I'm 90% certain that it will prevail. If I'm 80% certain, I will tell you, I strongly believe that it should prevail. If I'm only 70% certain, that position should prevail. If I'm only 60% certain, that should, if you've got all the facts just right and you're on the right day of the week, that should prevail. If I'm less than 50% certain, or if I'm slightly more than 50%, I will tell you that the position is more likely than not to prevail. If I cannot get myself to more likely than not to prevail, I think the other side may have a strong position, but we have substantial authority, and on the right day in the right court, we could win. I'm 40% certain. And if the best I can do is, you know what, there's a reasonable basis for that, I'm telling you that I'm 20% certain with respect to your chance of success. That table has been the subject of a lot of discussion. By the way, I mentioned the Form 8275. That's what it looks like. It's a disclosure statement. And a lot of us have been using this for some time to establish the good faith exception for a tax return position. We're disclosing the return position. We have a reasonable basis for it. We have to disclose it if that's all we've got. But the Form 8275 protects me as a practitioner and protects my client from penalty if it turns out that the IRS turns out to be right and we turned out to be wrong. Treasury Circular 230, Section 10.34 warns against a return position that lacks a reasonable basis. I've quoted Section 10.34 on the right-hand side of this slide. The Section 10.34 offers standards with respect to tax returns and documents, affidavits, and other papers. With regard to tax returns, a practitioner may not willfully, recklessly, or through gross incompetence sign a tax return or claim for refund that the practitioner knows or should know contains a position that lacks a reasonable basis. Is an unreasonable position, as described in Section 6694A2, including the related regulations and other published guidance. So if the return position doesn't have a reasonable basis, I can't sign the return, even if we disclose it. Disclosure only works if I have a reasonable basis or better. About those standards. AICPA Statement on Standards for Tax Services Number 1, Interpretation 1-1, Reporting and Disclosure Standards for Tax Services, classifies return positions again, frivolous. Disclosure won't help. Reasonable basis, you must disclose. Realistic possibility of success. Disclosure is not required, but I recommend it. Substantial authority, disclosure is not required. More likely than not, disclosure is not required. Interpretation number 1-1, Reporting and Disclosure Standards of Statement on Standards, talks about those return positions. A little more about those standards in a broader context. I picked this up from the article quoted in the lead to this little part of the talk from Tax Law Uncertainty and the Role of Tax Insurance in the Virginia Tax Review back in 2005. We know this topic has had lots of attention. 2005 was 16 years ago. And they're talking about the difference between tax evasion and tax avoidance, and they're observing that tax evasion is a very narrow area, while tax avoidance is a broader area. The spectrum of what is tax avoidance is broader, and on the low end, it might be close to clearly illegal. On the high end, it's clearly legal. But in between, as a CPA, I am my client's advocate with regard to tax matters. And so the breakage should be in the direction of a deduction or a tax benefit for my client. But in order to make those decisions, in order to make those judgments, I have to know what to disclose and when. I have to know how to counsel my client. I have to understand this area of the law and this area of tax enforcement. Tax home is where the job is. Angela West learned this the hard way. She's a traveling nurse. She had a full-time job in Kentucky and a part-time job in Kentucky. She went back to Georgia. She kept an apartment in Georgia. She went back to Georgia to go to church on Sunday and to do volunteer work for that church. But your tax home is where you earn your living. It's where you work. Her vehicles were registered in Kentucky. She had no business ties to Georgia and only did volunteer work for a church. Now stop. This is really straightforward. But what if you've been working from home because you're required by your employer to do so, and you've been working in North Carolina. That's where your job is. But now you're working from home just the other side of the border in South Carolina. Or you're working from home just across the border in Tennessee. Or you're working from home just across the border in Georgia. Is your tax home still where your job is? Is your tax home over there? Did you establish a tax home, or have the states agreed that your tax home can be where your principal residence is, even though you earn a living in the other state? Some states have such agreements. We need to be thoughtful about this. There is no universal answer, and especially right now, there is no universal answer when you are working remotely, and that remotely has you on one side of the state line while your traditional place of employment is on the other side of that same state line. Employer credits for employee paid leave for vacations. I found this illustration of that spiky little virus and a syringe to hit you with a vaccine. This is an information release. The IRS has updated its list of frequently asked questions, 123 of them, on paid sick and family leave tax credits available to an employer under the American Rescue Plan Act. This clarifies that eligible employers, those with fewer than 500 employees, can claim the credits for providing leave to employees caring for specified individuals obtaining or recovering from a COVID-19 immunization, in addition to getting the shot themselves and recovering from it if they have any after effects. So the latest version of this Q&A makes clear that the employer can get a credit for wages paid to the employee while the employee gets the shot and recovers, and also while the employee looks after a family member who gets the shot and while they're recovering. This Q&A includes information on how to calculate and how to claim the benefit. And oh, by the way, self-employed individuals, Schedule C filers, may claim the benefit on their Form 1040. Well, that's it. How the time flies. Almost 18 minutes. Thank you for joining me every week. Thank you for your support. Remember to stay safe. We are still all struggling to get through this together.